The part about the VA loan that nobody ever wants to talk about. Hey, everybody, this is Danny Barker with eXp Realty. I'm a Navy veteran, now a realtor, and I've personally used the VA loan multiple times. And today I want to talk to you about the part of the VA loan that nobody really wants to talk about. When I say nobody, I mean those realtors and those lenders out there. Because everybody loves talking about that good stuff, the zero down, the low interest rate, the no mortgage insurance, the flexible qualifications with the lower credit scores and higher debt to incomes. I mean, it's a beautiful thing. But there is this one piece of the VA loan that usually gets mentioned. It has to be. It's in the disclosures. It's in your settlement statement. Has to be mentioned. But it's like 3 seconds, and then they go, boom, on to the next subject. It's the VA funding fee. And I think that's a big mistake because once you understand it, the entire VA loan starts to make a lot more sense. Let's start with the simple question. Who is lending you the money? It's not the VA. The VA isn't handing us a big giant check to go buy a house with. Hell, the one I got on this house is $1,400,000. The VA did not give me that money. I got that money from a mortgage lender. And that mortgage lender has the VA insuring that money. Wall Street does it. Banks do it. Mortgage companies do it. But the people with the money are the ones that are giving up their money for you to go buy a house with zero down, super high risk. What if something goes wrong? You know, if you walk into a bank and you say, hey, can I borrow $500,000? And they're like, for what? And I say, well, I mean, I just need $500,000. If I could get $500,000 to my name right now, I could probably make a lot of money. Maybe I'll go buy a house. And they said, no, now you're talking. Now you're talking. Okay, so how much are you going to put down if you use it for a house? Well, nothing. I need the $500,000. I wouldn't be here if I had the money for the down payment. I would just buy something smaller, right? Oh, no. See, who's gonna back us up? The mortgage company's gonna say, who's gonna back us up? Who's gonna pay us back if and when something goes sideways? And I'm like, oh shoot, okay, that's where the VA steps in, right? And now the bank is definitely interested because I say, hey, the VA will cover 25% of your loss, 25% of the whole amount of the loan if you lose it, right? So now the VA steps in and they say, hey man, we got this veteran's back. They proved that they earned this thing. And that's a huge reason why the VA loan exists and why it's one of the most powerful mortgage products in America. So how does the VA help fund that system? They use the funding fee. The VA funding fee is set for if you put down less than 5%, if you put down less than 10%, or if you put down 10% or more, the funding fees change. If you have a qualifying disability, it's zero. If you receive VA disability compensation, it's zero. Eligible to receive compensation, but receiving retirement pay instead. That's for you guys out there that did your 20 plus years, retired, got your VA disability rating, but it was too low. So now you get your pension instead, but you are zero on the funding fee. And a surviving spouse, those gold star widows and widowers out there, zero. Purple Heart, while on active duty, zero. All these people get these zero funding fees. Not today, not tomorrow, not ever. It's a massive benefit when you unlock the zero VA funding fee, right? Now let's talk about where things get a little interesting. The VA Cash Out Refinance. So picture this, you go out and you buy a property for $500,000, your neighbors a few years later are selling for $750,000, and you're like, hey honey, that pool, the barbecue area outside, you know, all this, the hot tub, all this stuff that we've been putting off. If we were to get a new VA loan and take some of the cash out, we could finance all of these home improvements into our house, right? This is where somebody refinances and pulls cash out of their home. So instead of owing $500,000 minus what they've paid down, they're going to reset it to this new amount. Well, in a cash out refinance for the VA funding fee is 3.3%. You can't put a down payment. If you're pulling cash out, you're not putting cash in. So you can't buy it down like you can in the other ways, right? So it's 3.3%. On a $500,000 refinance, that's $16,500 up in smoke. Like gone. That's the fee. But if you have those zeros, the disability rating is the most popular one, then it's zero. The funding fee is zero for the cash out refi. So while you're active duty, or you don't have your disability rating to one of the qualifying levels, or you don't have a Purple Heart, this whole $16,500 funding fee is a loss. It'll cost you more than that if you pay all 360 payments going down the road, right? So I don't want you to do it to pay off your debt. I don't want you to do it if you're buying something that you don't really need, right? Remodeling the home, upgrading the home, improving the quality of the home, or any of your homes, actually. Borrowing from your real estate to strengthen your portfolio is a good thing. You can strengthen your portfolio by doing renovations, doing additions to properties, improvements to properties to improve the rental income, right? You can sell this property, take the cash, buy another property. You can refinance, cash out refinance the one that you're in. My house, when it's worth 2.5 million, maybe I'll do a cash out refi and pull $1 million out and put a down payment on 6 or 7 houses. That cash flow right away. I could buy a whole portfolio in other towns, right? And then the whole time I'm writing off the interest that I pay every year. Super cool, right? Now, because the funding fee is usually financed into the loan, the people don't really feel it. So the borrowers don't feel it, and that's how the lenders and the realtors get away with just saying, "Oh yeah, that's the funding fee. This is how it works. This was for buy," right? But it's like ordering a dessert and saying, "Just put it on the tab." The problem is that eventually that tab shows up. Now, here's where I might make some people uncomfortable. The people that are most likely to abuse a VA cash out refinance are often the people who don't pay the funding fee at all. Remember, I mentioned them earlier. Because we're exempt. Think about it. If every refinance costs you $16,500, you're going to think long and hard before doing it. But if every refinance costs you zero, suddenly the decision feels a lot easier. I've seen veterans use their homes like ATM. I've used my home like an ATM. Pull out money, pay off debt, pull money out again, buy a truck, pull out some more money, go on vacation. How about enough to buy some toys, sand rails, dirt bikes, quads? Pull out the money. You can fix all the problems that you created by the last time that you pulled out the money. You can consolidate all those credit cards, run those credit cards back up 5 years later, consolidate it again. And the whole time you've been living in this house and your equity, you're just gobbling it up as every day goes by. So careful with that. I don't want you to make that misstep. That's why I say, if you're borrowing money from your real estate or selling real estate, you should be using the proceeds from that loan and that sale to strengthen your real estate portfolio. The VA loan is one of the greatest wealth building tools that's ever been created, but only when it's used to buy assets instead of finance lifestyles. Now, here's the good news. The VA has another refinance option, and I absolutely love it. It's called the VA IRRRL, Interest Rate Reduction Refinance Loan. Unlike the cash out refinance, this loan is designed to improve your mortgage. You have to, when you do the IRRRL, it has to be at least 0.5% lower than your current interest rate. Your new loan could also be a higher interest rate, but you're condensing the terms. So you have 25 years left on your loan. You go into a 15-year mortgage, they're going to do the IRRRL for you to do that. Then they don't factor it in. So it's one or the other. You're going to pay it off faster, or you're going to pay less in interest. And you can also do it both ways. You could get a lower interest rate and pay it off faster, right? So this design this loan is designed to improve our mortgage, not so that we can go finance our shopping sprees and everything, right? The funding fee, the VA funding fee for this IRRRL is only 0.5%, 0.5%, not 3.3% like the cash out. But you are not allowed to get cash out. So there's no new truck, no new boat, no new giant television. No, I've earned this purchase. The purpose is simple: lower your interest rate, lower your payment, potentially shorten your term, sometimes even all three. Now let's talk about my favorite move. I call it the VA IRRRL Trifecta. Most people have never heard of it. Most lenders don't touch it. But it's funny because I was taught this by my favorite lender, Derek Evans. Most homeowners never think about doing it this way or how it could work out this way. Let's say that you do your IRRRL and the lender says, congratulations, your payment just went down. Most people celebrate, but the wealth builders do something a little bit differently. Step one, don't skip that payment. When you close a new loan, you don't make a payment on the first of that first month. You make a payment on the first of the second month, right? You're already used to making your payment. Let's take my mortgage, for instance, $7,100 a month. So if I refinance today, then I don't have to make a payment in July because it's June right now. And then in August, I'll have to make my first payment. Maybe my payment's coming from $7,100 to $6,500. Well, if I don't skip that first payment and pay either my $7,100 that I'm used to already or the $6,500 that is now more affordable, either way is good. Make that payment. Most people hear about this whole like first of the month and they're like, hey, we don't have to move. We don't have all the expenses that we had when we originally bought this place. The whole reason for the deferred payment in the first place, we're just going to exploit this situation. No. Write the check for $7,100 or $6,500, whatever your payment is or was. It's up to you. Bigger the better. And say apply to principal. If you do it online, you could literally click the box that says apply all to principal. Right? So step two is that you had an impound account. So you got to watch your mailbox. Remember that impound account is from the old mortgage company. That account that they collected to pay your taxes and insurance with that money, with your money. When the old loan gets paid off, that money is often refunded to you because it's your money. Most people take it in and put it in the bank. But I'm going to take it in, put it in the bank, and not use it, not invest it. I'm going to put it back to the principal. Apply to principal, right? So now I've just attacked the balance twice for more than I tapped it for to establish a new impound account. Yes, your owed amount goes up in an IRRRL if you impound your funding fee and your new impound account. So I've just paid it down more than it just went up. So now my owed amount is lower. Step three, call your loan servicer. It's not usually your loan officer. Your loan officer will definitely tell you who to call to reach the loan servicer. But you call your loan servicer, it's usually the company, and ask whether they allow a recast or payment recalculation after a major principal reduction. So not every servicer, like servicing company, offers it, but many do. And if they do allow it, your payment may be recalculated using the lower balance. Think about what just happened. You lowered your interest rate with the IRRRL. You lowered your monthly payments. You lowered your principal balance. That's the trifecta. Lower interest, lower payment, lower principal. Most people spend years looking for some magical wealth building secret. Usually it isn't magic. Usually it's understanding the rules better than the average person does. The VA loan is an incredible tool. The funding fee isn't a punishment. It's part of what makes the system possible. The cash out refinance can be useful, but it can also be abused. The IRRRL is one of the most powerful benefits available to veteran homeowners. Right now, you can go out and you can grab a house, and yeah, it sucks. 5.75%, 6%, 6.25%, 6.5%. right? Oh my gosh, that's so lousy. But here's the thing, there's so much downward pressure on mortgage rates that I personally would go and buy a house right now. And instead of taking 5.75, I'm going to ask the seller, hey, how much concessions are you paying? Okay, good. I'm going to take that. I'm going to take that to my loan officer. I'm going to say, hey, how much is left? Am I going to have to go any more out of pocket? And he's like, oh yeah, you got about $5,000 come out of pocket. I'm like, cool. How high can you put my interest rate? How much higher do you have to put my interest rate in order for you to cover some, most, or all of it? Give me 3 numbers. Some, most, or all. What you think is the best deal, I want you to put a star by that one, right? So now I'm going to sign on for a higher interest rate. So now I've got concessions from the seller and I've got credits from the lender for taking that higher interest rate. And I'm going to lock in a 7% mortgage right now. It sounds retarded and stupid. I get it, right? But once you're 210 days into that loan, you can do a VA IRRRL. And what's the number one thing that qualifies you for a IRRRL? 0.5% difference in your interest rate, in the downward direction of your interest rate. So all I have to do is make sure that I'm watching the interest rate at that 210-day mark is approaching. I'm in contact with my loan officer and I'm ready to strike while the striking is good. And you know what's really cool? In some cases, you might actually could do a interest rate buy down during your IRRRL. So yeah, you heard me right. Interest rate refinance reduction loan. You can buy the rate down even more. Cash, sure, they'll take it, but they don't need it. They will impound it. They will add it to your owed amount sometimes. Ask. Make them say no. The VA IRRRL is one of the most powerful benefits available to the veteran homeowners. If you want help strategizing how when's the next time you're going to use it, how can you use it most effectively? And the trifecta move may be one of the smartest moves most people never hear about. You got to work with professionals who care about your future. My network of veteran focused agents and lenders across the country is here to help when you need us. We're not trying to help you make the next payment. We're trying to help you build the next decade. And remember, nothing ever goes as planned. But wealth is built by people who have a plan.